How we doing, everybody? Here to be live on Facebook, LinkedIn, YouTube, X, Instagram. Thank you, Ion, for that. I have your comments up. Let me just check my Instagram screen. Ashley is on here. Sound is good. Thank you for that. Ashley, shall we get started? Welcome, everybody. I was just listening to the Pierre. Where am I? My camera's up here. Let's look at that. Welcome, everybody. I was just listening to the Pierre Poilievre, conservative leader in Canada, his live address to the Economic Club as I was logging in here. He's really good. He's really good. It's too bad he doesn't campaign very well, but his thinking and prescriptions for the Canadian economy, country in general, are pretty strong. But let's not talk about Pierre. Let's talk about Elon Musk while we wait for people to join us here on the live stream, because Musk proved to me today that I'm underpaid. Tesla shareholders yesterday approved Musk's $1 trillion pay package. Yes, I said it, $1 trillion with a capital T. The compensation package is his new 2025 CEO Performance Award for Tesla. It's a 10-year deal, so it's only a mere $100 billion a year. Let's not get carried away on this. It was proposed in September 2025, and it was approved by shareholders with 75% support. So this gives Musk 423.7 million shares, contingent on him hitting certain milestones. It would be about 12% of the company, and those shares would be worth $1 trillion. But he has to create a market cap in Tesla of 8.5 trillion for this all to happen, which means he needs to add about $7 trillion of market value to Tesla. So if he creates 7, he gets 1. That's the basic trade. The financial news story and the political press in particular seem to entirely forget that he has to create 7 trillion with a capital T dollars of value in order for this to work. The market cap, by the way, is not the only test. It's not that simple. It comes in 12 tranches, his milestones. By the way, tranche is a French word for slice. Did you know that? I thought it was something else. I know what tranche is in a financial context. In financial context, think of it as steps. Well, its derivation is from French, and it means slice. I don't know if you can have a tranche of toast. I don't know how that works, but there are 12 tranches in this compensation deal. And for example, tranche 1 is to get the market cap from where it is now. I don't know where it is now, but 1.1, 1.2, maybe in that range, trillion with a capital T to $2 trillion. And then there's 9 more tranches about adding 500 billion market cap each. And then the final 2 tranches, $1 trillion each, and like that. And there's also operational targets that need to be part of each tranche, like a cumulative delivery of 20 million Tesla vehicles, 10 million active subscribers in the self-driving software, delivering 1 million Optimus, these humanoid robots. Is that the right word? Yes, humanoid robots, 1 million robo-taxis, EBITDA, earnings before interest, taxes, depreciation, amortization of a substantial amount. Look, this is an extreme eat what you kill compensation package. In fact, now it just is. It's the most extreme eat what you kill compensation package I've ever seen. And I think there's a few lessons here. And one is believe in yourself. He's betting the farm on themselves. 2, shoot for the stars. And 3, maybe this is just relevant to me, but the third lesson here or observation is, what the F am I doing wrong in life? I don't know. I should probably get paid soon. I think that needs to be a new focus. By the way, podcasters and live streamers and people like me, we should have hot takes, right? We should say something that you haven't thought about, that other podcasters haven't thought about. Well, here's one to think about. Is this real? Is this $1 trillion pay package really a $1 trillion pay package, or is it a diversion? Is it intended to accomplish some other goal? Musk, as you might know, is quite possibly the most persuasive human being on earth. Some might argue that Trump is first and Musk is second. Did you know that Elon Musk has no marketing department in any of his companies? All of this is him, predominantly on X, as a podcaster, doing product launches. This is how he creates the news and gets the attention and persuades and gets you to buy into his stock that creates $1 trillion pay package. Now, if you're a listener to this content, that at Sinclair Range, well, we love our persuasion. And so we love following Musk and Trump and others like them for this persuasion in particular. And have you ever noticed, this is not a political conversation, but just as a persuasive lesson, have you ever noticed that Trump gets your attention, love it or hate it, by saying completely outrageous, and some might say beep crazy things? Have you ever noticed that? Very inappropriate things? Well, he does, and he does that, including in negotiation. And when he does it in negotiation, by the time you get through the the bat poop crazy stuff. I don't know how I say this without getting my channel blocked, so I'm trying not to, whatever, the batshit crazy conversation. By the time you get through that negotiation, you think to yourself, oh, wow, I only gave up 50% of this thing rather than the crazy 100% of his thing that he wanted. And you completely forget that your initial goal was to give up zero of that thing. It's like when Canada, US, and Mexico were negotiating the last trade deal in Trump's first administration. And we had this, I don't know what she was. Was she from Canada? She was the vice prime minister. There's a word for that. Deputy prime minister. That's the word for that. Chrystia Freeland, who might be the dumbest politician on the face of the earth. I can say that because she was from my riding at that time. And she goes to Washington, and she, on her way, insults Trump publicly in as many ways as possible. And at the end of the negotiation, she comes back and she says, Canada, we won. We won this trade negotiation because we gave up less than we thought we would have to give up. We only gave up 50%. He wanted 100%, forgetting that the whole point of this was to give up zero. Well, that's how Trump handles it. That's persuasion. That's how he comes out with these outrageous anchor in negotiation, which is that outrageous first position in negotiation might be called an anchor. Well, do you remember, bringing this back to Elon Musk, do you remember last pay package of his was worth $58 billion. It was approved by shareholders, but it was thrown out by courts in Delaware. Then he had to move to Texas, and I didn't follow the whole thing after that, but it became a problem. $58 billion became a problem. That's just outrageous. How could somebody be paid $58 billion? Well, this deal is now $1 trillion pay package, but is he really going to get there? Or another thing that the financial press never tells you is that there's these 12 tranches, these 12 levels to get to that full thing. But along the way, he makes tens of billions of dollars, even for meeting some of the easier tranches. I'm using the easier in air quotes. So don't underestimate the idea that the 1 trillion is the outrageous anchor, the opening bid in this pay package. And by the time you all in the court say, thank God he only got paid $150 billion, could have been $1 trillion. It could have been $1 trillion. All right, let's get started. People have had enough time to stream in. Welcome to the Weekend Review at Sinclair Range. My name is Scott Sinclair. I am founder, owner, and president of Sinclair Range. And the mission here on this live stream, which we do every Friday at 3 p.m. Eastern, is to give you some insight into the goings-on at Sinclair Range. This is your window into the real world of deals, decisions, day-to-day business adventures. And we try to, for the most part, cover our regular weekly segments, lessons learned of the week, interesting file or deal of the week, struggles of the week, my musings, observations of the week. So shall we get at it? Excuse me 1 second. This week at Sinclair Range, we worked with multiple lenders. This falls in line with our lesson of the week. Multiple lenders and borrowers all over North America, many of them this week, all trying to find ways to repay debt. The lender loaned the money. The borrower, do you hear my dog barking upstairs? I have a puppy and she's barking and I didn't put him outside. So hopefully that doesn't bother you too much. And we'll just kind of forge through this. So the borrowers are struggling to pay back the debt. The lender needs the debt back. The economy, particularly north of the border, is in serious trouble under this government. And everybody's trying to find ways to collect money and to pay money. And in these particular files, I think almost everybody is acting in good faith, which is terrific. It is a little bit unusual. In the distress space, often you find shenanigans going on, but I don't think in any of these situations, maybe one of them with one of the parties, but I think everybody's, working in good faith to try to pay it back. But even with that, what we're finding, and the lesson I think for the week here, is that borrowers and lenders, very quickly lose sight of the fundamentals. There are only five ways for a borrower to pay back a lender. That's the fundamentals. That's first principles. What are those five ways? Well, you can refinance. You can go to a new bank and you can say, hey, here's my receivables, my assets, my inventory, my other assets, my cash flow. Can you refinance me? And the use of proceeds is I'm gonna pay out the old bank. And if you're a good, healthy company with lots of security, you can probably get that deal done. Or you can go to the private debt market, sort of a non-bank lender, which we'll talk about more today, and try to get it done there. But bottom line is, one of the fundamental ways to pay your old lender is to get a new lender and to pay it off. Another way would be to generate free cash flow. We're growing. There's lots of free cash flow. Let's set out a schedule of payments to bring down this debt over time out of operations. That would be, and you have to be often growing and profitable and cash flowing for that to be a reasonable solution. But in the universe of possibilities, that is clearly a possible solution that we shouldn't lose sight of. Sorry, I'm just checking my Instagram screens as we go here. You could thirdly sell part or all of the business. People often forget about that. Sell part or all of the business. And that could be, well, we just sold the entire business as a going concern, and part of or all of the use of proceeds is to pay off the old lender. There's an option in the universe of possibilities. You could sell a division, in other words, a piece of the business. You could sell some equity, right? Bring in an equity partner, which is more like a financing, but it's selling part of your business. So that would be the third. The fourth would be to restructure the debt, which really isn't an option to pay it. It's more like I'm not paying it at all, right? The lender takes a haircut, it converts some into equity, it does different things. And that is, first principles thinking in terms of how you could deal with this debt, this obligation to your old lender. And the fifth is liquidate. Just shut the thing down, sell off the assets for pennies on the dollar with the auctioneer. Nobody wants to do that. Nobody wants to do that at all. But if you're considering all possibilities, that is certainly one of the possibilities. Only 5 ways to pay back your lender. Refinance, do it out of free cash flow, sell all or part of the business, restructure the debt, liquidate. That's it. There are no other possibilities. And some combination of those is also possible. In other words, you can do not just one of those solutions, but multiple of those solutions in tandem. And there is no sixth option. But what happens in these situations with stress and negotiations and sometimes hot tempers is that both borrowers and lenders forget that all those options exist, and they get overly focused on one or two. Go and refinance with another bank. If you fail, we're going to liquidate you. We're not going to restructure. We totally forgot that you might be able to sell your business, right? Or bring in some equity. And the borrower too. The borrower is just counting on going to the next bank and hoping everything works out. They're not thinking, hey, we should sell the business. We should bring in some equity investment, right? You need to think about all these things all at once. It's exactly what happened, by the way. Do you remember I told you the McQuillan Meter Services story, where this company is in receivership and it was focused on a refinancing, and the bank was focused on a refinancing. The refinancing came in, but only at like 50 cents on the dollar for the old bank. So the company said, hey, well, we're going to go try and find some equity and we're going to sell the business. And the bank said, no, you've already failed. We're going to liquidate. And the bank went from getting 100 cents on the dollar to it's not over yet, but I bet you it's way less than 10 cents on the dollar being their debt obligation. You need to look at all the options and execute on all the options, not necessarily all at once. If you're trying to refinance what you believe is a high growth or a healthy company, you don't also want to be in the marketplace trying to sell it. I get that. Okay. But you just need to know that all those options exist. And before you're toast, before you're liquidated, you should probably consider seriously all of those options. And many, many, many borrowers do not do that. And they don't get the advice to do that from their professional providers. Their professional providers go the other way around. They say, hey, you need to file Chapter 11, or you need to do a notice of intent to file a proposal in Canada, or CCAA, or receiverships. You need to do one of these things. Well, those things are mechanisms that you should think of as tools to execute on your plan, but they're not your plan. Your plan is to refinance, sell, bring in some equity, whatever. Okay, look at those 5 routes to dealing with those problems. You need to know where you're going before you select your tool. Don't do it the other way around. And speaking of which, we also saw at Sinclair Range this week that theme with startups, multiple startups looking for capital. If you are a founder, your new business, and even an early stage business, you have a mission. What problem are you solving? That's what you're doing in business. That's your message. What problem am I solving? What is my business plan? And the business plan is not intended to be a definitive forecast or projection or glimpse into what's going to happen in the future. That's not the value of a business plan. Nobody expects you to meet your business plan. The value of the business plan is that it forces you to think through the opportunities, the risks, how you're going to approach things, and to get your thinking in order, just to be clearly focused on what it is you're trying to do and why. And then, of course, you need to be flexible and you need to pivot. So you have a mission, you've got a business plan. And once that's all clear, what you need to do is nothing other than add overwhelming value to as many people as humanly possible. That's what you should be doing as a founder, entrepreneur, early stage company. In fact, at any stage, overwhelming value to as many people as humanly possible. That should be your focus. And what we're finding more and more right now is that too many founders, too many leaders of high growth, early stage companies, they're just obsessed with raising money as if that were actually the business. That is not the business. We just see that over and over, and a lot this week. They're confusing fundraising and executing and raising money. Capital markets are the tool, just like we talked about in the last segment. They are not the business itself. Build value first. Prove your concept. Deliver value to as many people as possible, and the capital will follow. It's way better to have capital be attracted to you because you've created energy with momentum, winning momentum, which is very much what my business course, personally, not the Sinclair Range course, but my business course at thescottsinclair.com. And a lot of my content is creating that energy to attract talent, to attract resources, both human and financial. So if you go to, by the way, just as a sidebar, if you go to thescottsinclair.com, you can do that right now. What you're going to find is a website, and there's a lot of tools for you. There's a business course you can buy, but there's also some free content. There's business coaching available. I don't recall what else is there, but there's a lot of products available to you to raise business capital and earn more profit. And one of those options is to register for the Inner Circle Deals and Capital. You've heard me talk about that almost every week on the Sinclair Range Week in Review show. And the Inner Circle Deal and Capital is a bi-weekly Zoom meeting where the participants are founders, entrepreneurs, investment bankers, intermediaries, capital providers, me, the Sinclair Range team. There's all sorts of really, really strong people on there. And the intent is primarily education, building community, and giving you an opportunity to learn, pitch your deal, and maybe even generate a business partner out of that or some investment out of that. It is not primarily the Inner Circle Deals and Capital is not primarily a capital providing group, but we have had some deals happen out of that. So anyways, it's if you go to thescottsinclair.com, you'll learn what I'm talking about in some of the products. If you want to do that, you can join the Inner Circle. It is free. All you have to do is apply. I think you can do that on thescottsinclair.com. Ashley can correct me if I'm wrong, but also you can just reach out in the notes on any one of the platforms that you're listening to right now. Speaking of deals, Sinclair Range, like we announced this last week, but really went live this week with a $6 million bridge loan that is structured as a debtor in possession loan, a DIP, DIP, debtor in possession loan. It's possession loan. It's in Alberta, and it bears repeating. I know we talked about it last week. So this company, a client of ours, will be heading into CCAA, a restructuring. And if you're in the US, that's more or less a Canadian equivalent of a Chapter 11. Now, what is a DIP loan, a debtor in possession loan? This is when the company seeks protection of the court, in this case in a CCAA, Companies Creditors Arrangement Act, and it says to the court, hey, we need some money because it always takes money to restructure and save a business. And we can't get that unless you, Your Honor, give us a court order which says that whoever gives us the money in the form of a DIP loan becomes super secured, super priority secured. In other words, the lender literally gets a court order that says no matter what else happens, you're first, DIP lender. You're first. You go ahead of the bank. You go ahead of the mortgage holder. You go ahead of everybody, and you can be first. Well, that's what this bridge loan is. It's really a DIP loan. It's super secured. And what's new, what we're doing this week is we're breaking that $6 million down into tranches because the $6 million ask doesn't really address the market. $6 million is more. One of the keys to raising capital is you need to understand who the capital providers are and create a product that fits what they do. $6 million is more than most angel investors, high net worth individuals would want to do on a particular deal. It moves you to a different market, and the different market is institutional. And the institutional market is a little more guarded, a little more boxy, like we do this, we don't do that. Whereas the high net worth individual market, the family office market, is more creative and generates better returns, but they're not trying to crank out a product. They're looking at a situation and deciding what works for them. Well, $1 million works really well often for a high net worth individual or a smaller family office, and 6 million might be too much, but we can tranche this. Do you remember that word, what tranche is? And so that's what we're doing. Anyways, the teaser letter is going on the Sinclair Range website, I think today, sinclairrange.com, if it's not there already. And if you want, go look at that or reach out in the comments here if you want to look at that deal, if you want to participate in that deal. It's a fully secured high yield loan is the intention, and it should be terrific. Struggles of the week. Let me just check my Instagram. We're all good there. Struggles of the week. So last week, these aren't struggles, by the way. This is just life, business life that I'm going to tell you about. But last week, I told you about a litigation initiated between Sinclair Range and 9 Point Partners, LP, I think they're called, out of Toronto. I talked about that a little bit last week. And the allegation here by Sinclair Range is that 9 Point, this is about 9 Point's conduct within their high yield debt fund and its impact on a portfolio company, 100% owned portfolio company of Sinclair Range. And all of this is alleged. None of it has been proven in court. So I'm not making any, claiming any facts whatsoever. So take all of this with a grain of salt. But we spent a great deal of this week, a lot of resources expended digging in to public filings of other borrowers, nothing to do with Sinclair Range, that have been in litigation with 9 Point, because in those other, all of these pleadings, affidavits related to CCAAs. If the company is insolvent and is claiming that it's insolvent because of the behavior of their lender, but if they are, then all of that is in the affidavits and supporting materials. And so what we are looking for is a pattern of alleged misconduct. And again, I haven't even read this yet, so I'm not accusing anybody of anything. But I'm pretty sure I know what's going on. I have friends and contacts within the group that was managing this money, and it's not good, and it has caused a lot of damage in my personal view. So, as I said, we're going to be sharing that journey as we go along with it. But I haven't read that stuff yet, so I'm going to read it, and we'll maybe update you next week on our issues with 9 Point. This week, I'm going to introduce a new one to you, and this one is about Zurn Elkay Water Solutions. Zurn, Z-U-R-N, Elkay, E-L-K-A-Y. Water Solutions, a major U.S. industrial manufacturer listed on the New York Stock Exchange, $8 billion market cap company. So this is Goliath. What is that? What is that phrase? Adam and Goliath? No. Somebody in Goliath. Anyways, I'm the small guy. Sinclair Range is the small guy. Zurn Elkay is the $8 billion big guy. And I want to read you some things that Grok told me about Zurn Elkay. Leadership and sustainability. The company actively brands itself as a leader in sustainability, emphasizing sustainability inspired as a registered trademark. That's how important this is to them. Approach integrated into their strategy. It's received recognitions and many, many awards as America's greenest companies. For example, in 2026 by Newsweek, America's climate leaders in 2025 by USA Today, America's most responsible companies 2025 by Newsweek. These accolades highlight its efforts in minimizing environmental impact through product innovation and operations. Zurn Elkay claims its products, again, this is all from Grok, its products have saved 32.5 billion gallons of water in 2024 alone through innovations like low-flow fixtures, pressure-reducing valves, yada, yada, yada. It reports preventing the need for 19 billion single-use plastic water bottles in 2024. That's pretty good. I would like that if that is true. Via drinking water products, while not explicitly committing to full net zero emissions by a specific date, which is 2050. The company has clear ambitions in this area. So this is all great stuff. That was from Grok, by the way. So if that's all true, here's my question for you. If that's all true, if this Zurn Elkay, $8 billion market cap company, very profitable, really an outstanding organization, if it's true that they're such environmental champions, why? Why is it the Sinclair Range is alleging in a litigation with them that they failed to meet the cleanup obligations, environmental cleanup obligations on an industrial site in a little town of maybe 1,000 people in Northern Ontario? Why is that? Why is that? These are allegations. They're in a statement of claim. We'll review that in future episodes. I just want to leave that question right now. Why is it that this seems to be an outstanding issue between this group and Sinclair Range and Zurn Elkay? It's interesting. We should follow along on that, and we will in future episodes. I have to tell you, if you're going to be in business, you have to be comfortable, not enthusiastic, it sucks, but you have to be comfortable and competent in litigious matters. Like, it's just part of the game. You run into people that make you in business counterparties that make you think you've been aggrieved, that you've been screwed, like 9 Point, allegedly, like Zurn Elkay, allegedly. And so, and then, you know, you need to be able to focus on your facts, understand the law, and be able to document the evidence, which requires a whole discipline within your organization that often we find clients don't have. And so that's what you need to do. You need to listen to your counsel. The primary advice of counsel would be not to talk about your litigations on a live stream. But I've promised to share this journey with you. All right, where are we on time? Yeah, we're right. Let me just close this up. You know what? My musings. We do a musings for the week. You know, there's an enormous private debt. Remember, I said we come back to private debt. Private debt, high yield, secured, turnaround financing is an enormous market in North America, estimated by Grok to be about $1 trillion and growing at 11% per annum. And investors in this space, I can tell you firsthand, generate exceptional returns. They can. Really, really exceptional returns and create huge wealth coming of that. And the problem is, from many of our perspectives, is that product is not available to the public. You can't just go and, you know, do a private company loan and put that in your IRA or RSP or whatever trust you're trying to figure out for the wealth of your family. It's just not an asset class that's readily available. Now, there are a few private debt funds, private equity funds that are trying to, air quotes, democratize this product and make it available. Now, some people might argue that they're trying to sell their bad assets to your retirement fund, but they're trying to democratize this and make it available. And it occurred to me this week that this is exactly what we do at Sinclair Range. We structure and manage these sorts of deals. We generate strong returns. And through this content, we try to teach operational investment. We try to educate on that, in particular through the ScottSinclair.com, which I already talked about. Well, it's occurred to me this week that maybe it's time. Maybe it's time that we explore ways to open up that world and to let accredited investors co-invest alongside us. Often people say our content is complex. My content is complex, it's difficult, like it's interesting, Scott, but I don't really understand it. Way over my head. But how would I get into this? Well, the opportunities are huge, and it is complex, and you do have to be careful. You do have to know what you're doing. But what if we could create an opportunity for you to invest alongside us? Maybe that's the way we should do that. And so that's my music for the week. That's what I'm thinking about. I'm thinking about understanding more how we can start researching. Well, I'm thinking about starting to research ways to use our expertise and deals and make those available to others, particularly sophisticated investors, accredited investors, particularly in the US, particularly through crowdsourcing. And we'll learn about that and see if that's a reasonable product line. Let me know your thoughts. Let me know your thoughts in the notes on that. Thank you for listening. Thank you for all those that reach out and participate and engage on this. If you are a company, if you are a business going through a transition, that could be high growth, it could be financial distress, maybe you're doing a deal, we exist here at Sinclair Range to help you. Reach out in the notes, and otherwise, we will talk to you next week. See you next Friday. Thank you for listening.